Are you there, Anna?
Yes.
Okay. Ali, how you doing?
Hi, sorry about earlier. I was trying to put some groceries away, so I had myself muted.
Well, that's not as bad as the mistake I made. I haven't made that mistake in a couple of years where I start babbling about the slides and you guys don't even know what I'm looking at or what I'm talking about. So let's start again, okay? And we'll
Thank
get
you.
and this is not a real long lecture, so it's not like we're going to be here forever. Hold on. Where the okay. Give me a second here.
Okay.
If there's a God in heaven, you now see the slides. Do you see the slides, Anna? Somebody let me know.
Yes. Perfect. Thank you.
We're good.
Here we go. That was just a warm up. Okay. Good to have you aboard. Take two. Analyzing transactions, the accounting equation. Okay. Define the accounting elements. We talked a little, not we talked. We're going to talk about a business entity. It basically means a company that's in business to make money for its shareholders, for its employees, for the ownership. And it's important to keep the entity's finances separate from the owner. With a small company, you might be sitting at your desk and the boss comes out and you're the accounting person and the boss says, give me a check right now for $1,000. Well, the boss is certainly entitled to do that. It's her company or his company. You're the accounting guy. You got to know how to code it. And you say, no problem, boss. What's it for, please? And he says, I'm taking my wife to Las Vegas over the weekend. Well, at that point, you know it's not a business transaction. It's a personal transaction and needs to be handled in a certain way so it doesn't impact the company's reports. That's all we're saying there. You keep the personal business of the owner away from the business itself. And a business may have assets and liabilities, and it may have other types of assets and liabilities. Non-business assets are not included in the business's actual accounting records. If the owner invests money or other assets in the business, now you're talking about a business transaction, okay? What's an asset? An asset, items owned by a business that will provide future benefits. In other words, anything we own that's of any value at all. And it doesn't necessarily mean we've paid for them, believe it or not. For example, we might buy inventory from a supplier and we're not going to pay the guy for 6 months because that's the deal. That's still an asset that we own. What are some examples? Cash, that's our favorite asset, as we were saying. Merchandise, furniture, machinery, land. Accounts receivable. Let's pay particular attention to accounts receivable. The amount of money owed to the business by its customers as a result of making sales on account. In other words, it represents the money owed to us by our customers at a particular point in time. Accounts receivable. I run a company here and my accounts receivable is $1 million and Ali owes me 700,000 and Anna, you owe me the balance of 300. That's accounts receivable. Key in on the word on account or on credit. On account. When you see the word on account, you know there is no cash involved in the transaction. We are either going to pay somebody later or we're going to get paid later. So we have assets, huh? Liabilities, something we owe to another business entity. and it's going to cost us some cash in the future. A liability, a debt that could be paid with cash, goods, or services. I guess if we didn't have any money, we could tell the guy, well, you can take some of our inventory or something. Liabilities, it's a payable, it's a debt, it's an IOU. It's how much we owe to our suppliers at a particular point in time. Accounts payable is the classic. All companies have accounts payable. Accounts payable is a non-contractual. There's no notes to sign or anything. You're doing business on trust with your trading partner. Accounts payable. Notes payable is different. Notes payable is a borrowing situation. You borrowed money from the bank and you owe the money to the bank. Notes payable. Here's accounts payable. An unwritten promise. And that's an important part. It's an unwritten promise to pay a supplier for something you purchased. Referred to as making a purchase on account. The reason it's an unwritten promise is you might do business with a company every day. You might be buying something from them every day. You can't be writing up contracts every day or a purchase order like crazy. You are going to trust that person to provide you with the product you need when you need it, as they're trusting you to pay. So there's no note payable here. There might be a contract in the form of a purchase order that says we're going to drop off 10 cars a week to your parking lot or something. This is called making a purchase on account. Add a few words to on account. On account of no cash. On account of nobody had money. Be careful. Don't confuse accounts receivable, accounts payable, which is easy to do at first. Say to yourself, are we waiting to receive money or are we going to have to pay money? Accounts receivable and accounts payable are the same thing when you think about it. Accounts receivable, though, is the company that shipped the product and expects to get paid. Accounts payable would be the buyer, the purchaser who's going to pay later. Notes payable, formal written promise to pay. There's all kinds of specific sums of money at definite times. It's a very formal contract. And then we have something called owner's equity, the amount by which the business assets exceed the business liability. We can also call it net worth, capital, stockholders' equity. You have a business and that business has $1,000 in assets and you have $400 in liabilities. The difference between the two is $600. That's the net worth of the company, okay? Construct the accounting equation. Take a look at it now for the first time, The accounting equation. Assets equal liabilities plus equity. Assets equal liabilities plus equity. So assets are on the left, the others are on the right. Assets equal liabilities plus owner's equity. Never forget that. And they're just showing you an example here. If a business has total assets of $60,400 and liabilities of $5,400, what's the equity? Well, we're just going to say our assets are $60,400 minus $5,400. That gives us $55,000. And there is a look at the accounting equation with some numbers in it. $60,400 of assets equals $5,400 of liabilities plus $55,000 in equity, or 60,400 minus 5,400 leaves you with the net worth of the company. And this equation must always remain in balance. And I don't think that's ever going to be a problem for anybody, based on nobody does this in pencil and pen anymore like we had to do 50 years ago. Wow. You know what makes me feel old? I got an invitation to the 55th high school reunion. Boy, that makes you feel old. And There were some pictures in there, and believe me, a lot of them look like a bunch of old goats. It's incredible. Anyway, analyze business transactions, okay? What's a transaction? Anything that affects the business, anything that affects the numbers, let's say. We got the electric bill, that's a transaction. We have to process the payroll, that's a transaction. We received goods on our shipping dock, transaction. We're paying somebody, somebody's paying. Those were all business transactions. They all affect the accounting equation through specific accounts like cash, accounts receivable, etc. When I say an account, you're going to learn about the general ledger, which represents the quote books of the company. If you ever heard that expression, I want to see the books. They're cooking the books. It's the formal record of the company. And in that general ledger, you have a bunch of accounts, a separate record or folder used to summarize the changes in each asset, liability, and owner's equity. So let's take a look at this, analyzing business transactions. What happened? Pretty simple question, huh? Make sure you understand the event that's taken place, huh? That puts things in perspective, in context. What accounts are affected? Identify the accounts that are affected and make sure you know that they're either an asset, a liability, or an owner's equity. And then make sure that the accounting equation is in balance once you have increased or decreased the accounts. Make certain that the accounting equation remains in balance, okay? Show the effects of business transactions on the accounting equation. Mitchell's campus delivery. This guy delivers pizza to UCSB and SBCC and Westmont and whatever. So it's a simple little business. So let's see what this guy's doing here. Say hello to your first transaction. Mitchell Williams, he's the owner. He invested $5,000 in the business. Excuse me. He took $5,000. Oh, pardon me. I'm sorry. Let me just take a snort here. That's better. Mitchell took $5,000 of his own money and he put it into a new bank account. And that bank account is called Mitchell's Delivery. So what happened? That's what happened. He put money into the company. Identify the accounts that are affected. Well, your cash is going to change. Your cash was zero. You had nothing there. So the cash is going to go up and the capital is going to go up. Classify these accounts as assets, liabilities, or equity. So let's see. Cash is clearly an asset and capital, well, that's capital. That's owner's equity. So right now we're going to have assets of 5,000, no liabilities, owner's equity of 5. Let's look at it more clearly. Here is your general ledger, we'll say, okay? The assets are now $5,000. There are no liabilities, and the company has a net worth, owner's equity, or capital of $5,000, okay? He bought an asset for cash. What happened? He bought some equipment, some delivery equipment, scooters or something. Well, what accounts are affected? Well, we see the word cash right there, so we know cash is affected. And what did he buy? He bought delivery equipment. So these are assets. Both of those are assets. So the cash is going to decrease. He's spending some of his money, and in return, he got some delivery equipment. Traded one asset for another. Take a look. Cash has now gone down to 3,000. Delivery equipment has now gone up to 2,000. So he still has 5,000 in assets against owner's equity of 5,000. No liabilities yet, huh? Here he bought more delivery equipment. Good gosh. He bought delivery equipment for $1,800 on account. What do we say when you see the words on account? You know there was no cash involved in the transaction. It's either going to be accounts receivable or accounts payable. Mitchell bought the equipment, so he's going to have to pay for it. So therefore, it's accounts payable. And the deal is he's going to pay over the next 3 months. So what are the accounts that are affected? Delivery equipment is going to go up again, and accounts payable goes up again. Take a look. Take a good peek here. Cash still $3,000. Now he has $3,800 worth of equipment, but he has a liability now of $1,800. He has to pay that later. So $6,800 in assets minus $1,800 in liabilities comes to $5,000. We are in balance, 6,000, okay? Remember, he bought that motor scooter for $1,800. Well, he's going to pay some of it now. He's going to pay some of it. That's what happened. What's going to be affected? Cash is going to go down, and so is accounts payable. Remember, accounts payable is the number that you owe to your suppliers. So cash is an asset, and payables we know is a liability. Cash is going to be decreased, and so is accounts payable. And there we go again. Cash has now gone down to $2,400. Delivery equipment still at $38, but he's reduced his liability by $600, and we're still in balance. $6,200 equals $6,200. Now let's introduce something we've not seen before: revenues. Revenues. We're going to talk about revenues and expenses. Revenue is a sale. A revenue is a sale. The amount of business charges customers for what they sold. Recognized when earned. And man, is that an important sentence? What you're going to be learning going forward is we're teaching what's called accrual accounting, ACC or UAL, accrual accounting, which is the only way to keep track of financial businesses. That means that we record the sale, the revenue, if you will, the income, when the service is performed or when the goods are shipped. We don't care whether it's paid or not. And that's something you have to understand, the accrual basis, okay? So let's see here. Revenues could be sales, delivery fees, services rendered, consulting fees. You could have rent revenue maybe. Where I worked for many years, we rented out part of the factory to a small business. Interest revenue, sales. Revenues are sales. A revenue increases equity. Can you remember that? Revenue increases equity. Expenses are the opposite. They represent the decrease in assets or equity as a result of efforts made to produce the revenue. Separate accounts exist for each type of expense. Either decreases assets or increases liabilities, but expenses always decrease owner's equity. Examples: rent expense, salaries expense, supplies expense, taxes expense, insurance expense, all kinds of expenses. You have 100 of them. Here's a question that pops up on the test once in a while. The concept that income determination can be made on what's called a periodic basis. Any accounting period of 12 months is called a fiscal year. It's just the concept that any business can be broken down into 1 month and then analyze and come up with the operating results for that particular month or quarter, 3 months or a year. And a fiscal year is any accounting period of 12 months. It has nothing to do with the calendar year. A lot of companies, their fiscal year might begin May 1st, for example. Okay, net income versus net loss. I bet you didn't have to go to college to understand this, huh? You make money if your sales are higher than your expenses. Who knew? If your expenses exceed the revenue, you have a net loss, Remember, I was talking about keeping the owner's business separate from the company's activity. We do it through withdrawals. The owner taking cash or other assets from the business for personal use. We call that a withdrawal or a drawing. And what that does is reduce the owner's equity as well as the cash, also called drawing. It is not an expense, It's a reduction in the equity of the company. If this company was worth $10,000 and the owner came out and said, give me a check for $1,000, now the company's only worth $9,000. Notice this expanded now, we'll call it an expanded accounting equation. Assets equal liabilities plus owner's equity. Notice owner's equity now has two components, capital and drawing, and it's also impacted by revenues, which increase the owner's equity, and expenses, which decrease. The accounting equation is now expanded to include revenues, expenses, and withdrawals. And with that, we're done with building up the equity. Okay, you're not going to have to worry about any more categories to this until accounting 230 maybe. Note that the revenue increases owner's equity, expenses and drawing both reduce it. So let's go back to some transactions. Delivery revenues earned in cash. Mitch dropped off $2,100 worth of pizza for the faculty meeting over here, and we handed him a check for $2,100. That's what happened. He sold his product, he made a delivery, and he earned cash. So identify the accounts. Cash is going to go up, which is an asset. Delivery fees, which is a revenue account, is also going to go up. So let's see how it looks. And here we go. Assets. Cash went up $2,100. Revenues went up $2,100, and we're still in balance. Assets equal liabilities plus equity. Uh-oh, we got to pay the rent, huh? Can't avoid that. So what happened? We paid the rent. What accounts are going to be impacted? Cash. Whenever you see paid, you know it's cash. Paid means cash. Identify the accounts. Cash is going to go down. Rent expenses are going to go up. And note, we've now taken 1,000 cash away. Make it a little bigger if you need it. Take the cash away. And here are your expenses going up. So right now we have a revenue of $2,100 and an expense of $1,000. So far, it looks like he's making a little money, huh? Paid the phone bill. Got to do that. Paid the phone bill. What happened? Mitch paid the phone bill. Well, that's an expense we keep track of in a folder called an account. Phone expense increases, cash decreases. So these expenses decrease owner's equity. Cash goes down by 100, and so does equity. So let's take a look at it. Assets go down 100, and expenses go up 100, which has the same effect of reducing owner's equity. Delivery revenues earned on account. What did I say on account means? No money, no cash. So you eliminate cash from the transaction immediately. What happened? Mitch performed delivery services in the amount of $2,400. He delivered $2,400 worth of pizzas to UCSB. But the deal is he's not going to get paid till later. Cash is not received at this time. So it's on account. We know there's no cash. On account means it's going to be accounts receivable or accounts payable. Well, we're the ones we're going to get paid, so we know it's accounts receivable. So we're going to increase receivables and we're going to increase revenue, which means that the equity is going up as well. And here we have it. Accounts receivable. UCSB owes us $2,400 for pizza, and the revenues went up, and therefore the equity went up. We bought supplies for cash, and the supplies are going to last several months. Supplies should be recorded as an asset when they're purchased. When you buy supplies or an insurance policy, they are classified as assets. You are not going to record an expense until you actually use the supplies, okay? You bought a case of paint, big case, 24-gallon cans of paint. Well, that's an asset when you received it. And then next month, when you use it to paint the building, then it becomes an expense. So what's affected here? Well, supplies are going to go up. Cash is going to go down. They're saying we paid $80 in cash. And look at how our equation is growing. We now add supplies and we reduce cash. And we're still in balance. Supplies is what we call a prepaid expense, since the supplies will be charged off to expenses when they're consumed. And we're going to do a lot of that when we get to chapter 4, I believe. Start learning about adjusting journal entries, okay? J, cash receipts from prior sales, huh? Mitch received $1,900 in cash for services rendered earlier. Okay, so what happened? Oh, one of our customers paid us. Owner's equity is not going to be affected because we already recognized the revenue 3 months ago when we sold the goods, when we delivered the goods. So now we're getting paid by a customer, which means accounts receivable is going to decrease and cash is going to increase. It's a swap of assets. And here it is. Cash went up $1,900. We received cash. Accounts receivable went down $1,900. And we're in balance. Remember, revenue is recognized when earned, not when cash is received. Same thing with expenses. That's getting ahead of us a little bit, but you'll get familiar with that pretty darn quick as you do some homework. Whoa, here's a tough one. Purchased an asset on account, but we made a partial payment. Wow. What happened? He bought a scooter for $1,000 and he had to pay $300 up front, and he agrees to pay the remaining $700 over the next 4 months. So now you're seeing a transaction that impacts 3 accounts. First time we're seeing that. Identify the accounts that are affected. He's got more delivery equipment. He has less cash, and he has an increase in his debt, in his accounts payable, okay? So look at your first transaction that goes beyond 2 items. Let's see here. He bought delivery equipment for $1,000. He paid $300 in cash, and he's financing the rest. He's going to pay, like I said, in the next 4 months or something. By the way, every transaction in accounting requires 2 accounts. 2. That's why it's called double entry accounting. 2 accounts at a minimum in any transaction. Bought an insurance policy, $700, gonna last us 7 months, huh? The moment you bought that policy, you now have an asset because you don't have the benefit of the policy yet. Let's assume he bought this policy in December of 2022. Well, he didn't have any insurance in December. He bought the insurance policy to cover him in 2023. So when January expires, so does 1/7 of that $700. Then we're talking expense, okay? Since the policy provides future benefits, should be recorded as an asset. And again, what accounts are impacted? Prepaid insurance, asset. Cash is an asset. We exchange one asset for another. Now this thing's really getting busy, huh? Here's prepaid insurance. We started with just cash as an asset. Now we have cash, receivables, prepaid supplies, prepaid insurance, and delivery equipment, huh? 10,300. Insurance went up 700, and cash went down commensurately. Both supplies and insurance are recorded as assets because they will give us benefits in the future. Payment of wages. Okay, Mitchell has people driving those motor scooters around using that delivery equipment. What do? They deliver his pizzas, and now it's near the end of the month and he has to pay them. So let's see, we're paying our wages to employees. Well, cash is certainly going to go down unless we're paying them in pizzas, which I doubt. We're going to pay them in cash. Cash goes down, and that's an expense. And let's call it wages expense. Let's call it salaries expense. Some companies call it salaries and wages expense, huh? So here we go. We spent the money, $1,650, and we increased this expense by $1,650. So far we have revenues of $4,500, expenses of $2,750, still making money. As with other expenses, cash is reduced and owner's equity is reduced by increasing an expense. Deliveries made for cash and on account. Here is another one where we have 3 items to worry about. What happened? What happened? We delivered $3,500 worth of pizza to Westmont. Wow, that's a lot of pizza. They gave us $900 in cash as soon as we turned the pizza over to them. And I agreed, Mitchell agreed, that they will pay us later $2,600. So what accounts are affected? Cash went up and accounts receivable goes up and revenue went up. That's a classic sale, right? So cash is going to increase by 900. Receivables will increase by 26, and the full sale was 3,500. Here we go. Sales, $3,500. Wow, our revenues are now up to $8,000, huh? We received $900 in cash, and the balance is going to be in the form of accounts receivable. Recording these revenues impacts 3 accounts while we remain in balance, and it increased the equity, huh? Let's look at our withdrawal. Now here's what we're talking about with the owner coming in and taking money out of his own company. Mitchell took $3,000 out of the business for personal expenses. That's all we need to know as an employee. The boss can take that money and do whatever he wants with it. It does not affect the company in terms of the profit and loss, in terms of the net income. What it does, though, is it decreases the owner's equity. So what we're going to do is cash is going to decrease by $3,000, and the drawing account is going to go up by $3,000, and in so doing, that reduces equity. Boss took $3,000 out to go on vacation. Look at the $3,000 here on delivery. The drawing, Mitchell Williams drawing up $3,000. that has the impact of reducing equity. Your equity is your capital minus the drawing, plus your revenues minus the expenses. Withdrawals by the owner are reported in the drawing account, which is part of your equity. Withdrawals are the opposite of investments, if you want to think about it that way. Remember, our first transaction was Mitch put $5,000 in the company, and we increased cash and we increased the equity. This is the opposite. He's taking money out of the company. Withdrawals are an opposite of the investment. Just like expenses, the drawing account will increase, but cause a decrease to the owner's equity, huh? Now, we went through a whole bunch of transactions. Let's spend a few minutes, prepare and describe the purposes of a simple income statement, statement of owner's equity, and balance sheet. These are the three major financial statements. Every company produces an income statement, a statement of the owner's equity, and a balance sheet. They tell you different things about the company, and anybody who's investing in a company wants to see the financials. You need to come up with good financial statements. Otherwise, no one's going to do business with you. No one. If you want to buy $1 million worth of goods from somebody, they're certainly going to want to see your financial statements, and they want to see what your payables look like, and they're going to do it through the balance sheet, the income statement, and the equity statement. Three commonly prepared financial statements. Note the income statement must be prepared first. You have no choice. You must do the income statement first, because we're going to take the resulting income and use it to increase the equity on the statement of equity. And then when we've got the new equity number, only then can we prepare the balance sheet, okay? So let's take a look at what we have here. The heading is important, the name of the company, the title of the statement, and the time frame. For example, Mitchell's Campus Delivery, income statement for the month ended June 30th, or for the month of June 2025. Wow, we're getting out in the future here, 2025, huh? You ever hear that old rock and roll song, in the year 2525? Nah, you guys are too young, Jesus. Guidelines preparing financial statements. They're prepared primarily for users not associated with the company, following a standard format. So they expect to see these statements laid out a certain way. And here they talk about double lining, underlining, not underlining. I'm not going to worry about that, okay? On the balance sheet, assets are listed from most liquid to least liquid, huh? Liquidity. Liquidity measures the ease with which an asset can be changed into cash. Cash is liquidity. Accounts receivable is very liquid. You know you're going to collect that money soon. Your inventory is a little bit liquid. So they're listed from the most liquid to the least. Hold on. Oh, this thing was beating me up here. Take a look at your income statement, everybody, huh? Your first financial statement. The income statement records the profitability of the company for a period of time. It is simply, when you boil it down, revenues minus expenses. Revenues minus expenses. Expenses are subtracted from revenues to get the net income. And it can also be called the P&L statement, profit and loss statement, or the operating statement. So let's see here. Where did we get these numbers, huh? You see that $8,000 and the 10 and 1650? Where did we get those numbers? They came right from our general ledger here. Here's the 8,000. Here's the 2,750 in expenses. And that $2,750 in expenses, if we remember, were wages, rent, and phone. So this business earned a profit of $5,250. How about that? That's a pretty darn good return on your money. That's like 70%. So Mitch did a good thing by opening the business. He took a risk, and the risk paid off. If he put the $5,000 in the bank for a year, you're lucky to walk out with $50 more at the end of the year with these low interest rates. So you do the income statement first to get the income. Now you're ready to do the statement of owner's equity. It reports the activities that affect the owner's equity for the month. And you're going to take the net income from the income statement and put it into this report. Now, students tend to get a little nervous at this statement, but it's not that tough if you break it down. It's going to be beginning equity, which is 5,000, plus net income minus withdrawals equals the ending. That's not so tough, huh? Beginning balance in the equity was 5,000 after we made the initial investment, 5,000 plus the income minus the drawing. So this company is now worth on paper $7,250. It grew from a $5,000 company to a $7,250 company. Again, that's pretty darn good. Now that we've done the statement of equity, we can do the balance sheet. Oh, the balance sheet. The balance sheet reports a firm's assets, liabilities, and equity on a specific date. The balance sheet is a representation then, if you will, of the accounting equation. The balance sheet confirms that we're in balance, and we can call this the balance sheet. Some people, snoots, they want to call it the statement of financial position or financial condition. It's a balance sheet, okay? And then again, where did we get these numbers? I see 470 for cash, 3,100, 80, 470, 3,180. Look, right from here, 470, 3,100, 80. And the balance sheet represents the presentation of assets equals liabilities plus equity. Hey, that's our accounting equation. Total assets, 9,150. Total liabilities, 1,900 plus the 7,250. Add them up, 9,150. So this guy is a pretty good looking set of financial statements, I would say. The accounting process, 3 phases. Input, processing, output, IPO. Try to remember that because for some reason, they like to put this on the test. Since this is an online class, I can't make up my own test. Makes it a little harder to teach toward the test, if you know what I mean. But I noticed they put this one on, IPO, input, business transactions, provide the input, processing, you recognize the effect, and then the output is the financial statements, okay?
Okay.
And guess what? That is the end of our lecture, huh?
Nice.
Anna's no longer with us. Are you here, Anna?
I'm here. I'm just muted.
No, I didn't see you. I wasn't. Any questions or any comments, Anna?
I have a question from the textbook. They mentioned at one point that capital is not the same thing as cash.
Oh, no. Two different things. Cash is just that. That's coins and bills and what you have in your checking account. The net worth is or equity is simply the difference between assets and liabilities. Cash is not the same thing as net worth. Cash is just one of many assets a company may have.
Oh, wow, okay.
Okay.
Net worth is the amount that the assets exceed the liabilities. The only time the cash equals the net worth is when we start the business with cash. That's all. The cash may go up and down, and the equity may go up and down. Does that help, Anna?
A little bit. I think I'm stuck because when people talk about like starting capital, to me that is the same thing as cash. So I think I just need to like readjust the definition in my brain.
Yeah, cash is just that. That's money. The net worth is the assets exceeding the liabilities. Think of it this way: you could start a business with no cash. You can start a business by putting machinery into the company, let's say, okay? You have no cash, but you have a couple of darn good machines and you have some raw materials. So you start your business with an increase in machinery and equipment and an increase in equity. There's no cash at all, okay? Then you make a sale for cash. The equity is going to go up, and now the equity includes the machinery plus the cash.
Okay.
All right. You good, Allie?
Just one quick question.
Sure.
You mentioned that the supplies are also considered assets.
Say it again, please.
You mentioned that supplies are also considered assets until
time
they're
of-
being used.
Yes, at the time of purchase, yeah.
Correct. Okay. How about if it's an office supply?
Same thing. That's pretty much what we're talking about. Office supplies, yeah. Yeah. You have a big business, say, and you go out and you buy all kinds of office supplies. You got boxes of pens sitting there. You bought $500 worth of pens, and they get put in a closet somewhere. At that point, those are assets. You own those, right?
Correct.
But as people come in and take the pens out, to the extent they use the pens, it becomes an expense. You record the expense in the future when the pens are used. And we're going to get into this in great detail in a couple of chapters, but think of it this way. You bought $500 worth of pens, we'll call them, supplies. And now the month has ended. We need to know if we still have $500 worth of pens there. So we go back and count it in month end, and we only have 200 pens left. Well, that means we used or expensed 300, and we're gonna hit an account called pen expense or stationery expense. Make a little bit of sense?
Yes.
Yeah.
Okay.
That's a good question.
If you have supplies, this maybe is something we'll cover later, but if we have supplies that you can't use anymore or they're not going to get used, is that, if you get rid of them, is that an expense, or
That's
does
a
it
great
become
question.
an expense the minute
What a-
they're
what
not
a-
usable?
What a good question. Yeah, absolutely. If you bought a bunch of supplies, and say you bought some toner, I like toner. You bought a bunch of toner for the copy machines, and then you realize that this toner is no good. It's not, and it's not the vendor's fault. You just bought the wrong stuff. It has no value to you. Yeah, you have to throw the stuff out and record a loss. If that's what you're asking, Anna, yeah, you record a loss. That's a good question, because one of the principles in accounting is you always record and anticipate losses. You always anticipate losses and record them. You don't do the same with gains, though. So that's a good question.
Okay.
Cool.
Are we okay here?
Yeah, we're good.
Yeah.
All right,
Yeah,
Ally, do you make a motion to end the meeting?
Yeah, I say it's over.
I sure hope to see you next week, guys.
Bye.
Bye-bye.
Thank you. Bye.